The market has entered a downward trend, so let me talk about roughly when we might be able to get out of this slump. By looking at a few simple indicators, we can quickly understand the current situation. First of all, the main reason the market is experiencing a broad decline right now is the rise in US Treasury yields. As the 10-year yield surpassed 4.5 points, bonds became more attractive than stocks, leading to portfolio adjustments. This automatically triggered selling pressure across stock portfolios. Holding bonds instead of stocks is less burdensome, and if you hold them to maturity, you can lock in your returns. The reason bond yields are surging like this right now is because the recently released CPI and PPI reports showed that inflation has not been brought under control. Inflation is still ongoing, and the recent macroeconomic announcements have ignited the markets. After the PPI announcement, the Fed's stance changed significantly. Originally, the market expected that the Fed would lower interest rates at least once this year. However, with inflation surging again and the job market remaining strong, there is no longer any justification for lowering rates. Right now, instead of a rate cut, there is talk of a possible rate hike in July. That's the situation with the macro side, but the indicators are what's important. There are usually 2 or 3 important macro announcements each week, and after these announcements, you can tell whether the macro factors are having an effect by looking at the market's options volume. A representative example is the put-call ratio. The put-call ratio visualizes the volume of options in the market. If the indicator rises, it means the volume of puts is increasing, and if the indicator falls, it means the volume of calls is increasing. On May 13th, the PPI was announced. After the announcement, the market fell slightly, but starting from the next day, the 14th, the put-call ratio surged. This means that banks or institutions are urgently hedging, and as a result, the number of put options in the market has rapidly increased. In other words, when the put-call ratio index rises, stock prices tend to fall. If it rises to the peak, the market will likely find a bottom to some extent, but since there is still plenty of room for it to go up, opening a long position carries significant risk. Next is the Goldman Sachs risk assessment model. When bond yields had just surpassed 4.5 points, stocks held up better than expected. Some of you may have wondered why that was the case, and this chart explains that part. If the chart exceeds 1 or higher, it indicates a period of greed, and this dotted line was only breached during the 2008 financial crisis, the 2017 bull market, and the peak of the 2021 COVID-19 liquidity bubble. Looking at the current situation, regardless of whether US Treasury yields rise or not, major global capital is judging that the economy is strong right now, ignoring interest rates and investing in risk assets. On the positive side, this means the market is extremely strong, but on the other hand, it will be difficult for things to get any better than this, so it's time to prepare for an upcoming correction. If you currently have profitable positions, rather than aggressively doubling down, it's a time when you should realize some profits, as we've reached a risky peak where you need to consider the downside risks. Bitcoin has also been on a downward trend since the number of put options in the derivatives market increased significantly. Most banks and institutions are preparing for a downturn, so from now on, you should structure your positions to align with a bearish phase. When the market reaches a certain bottom, it would be good to check the Bitcoin price at the moment when the put-call ratio, which I mentioned earlier, hits its previous high.